Hello, and welcome to another episode of Furniture Industry News. Today is December 3rd, 2025, and I'm glad you're tuning in. Let's dive into the latest developments in retail, manufacturing, and the broader currents shaping how people shop, all of which matter if you're designing, manufacturing, or selling furniture right now. First up, a major shakeup at Macy's Incorporated. The company recently surprised many by delivering a solid third quarter, turning expected losses into profit, with comparable store sales growing and senior management calling the results a sign that its turnaround strategy is working. Under CEO Tony Spring, the so-called bold new chapter approach seems to be resonating. Net sales reached about $4.7 billion, and adjusted earnings came in at 9 cents per share, outperforming earlier projections of a significant loss. What's interesting and especially relevant to the furniture industry, luxury banners under Macy's, namely Bloomingdale's and Bluemercury, continue to perform well, and Macy's plans to extend its private label overhaul into its home department next year. That suggests they might reintroduce or reposition furniture and home goods offerings under refreshed private labels. Historically, mattresses have sold better than furniture at Macy's, but the fact that they are focused on renovating their home department signals possible opportunities, either for furniture suppliers or as competition depending on your role in the industry. Still, Macy's is cautious. Their customer base is described as choiceful and value-oriented, which means they expect clearance and discounted merchandise to play a bigger role. With interest rates where they are, the company doesn't expect a major rebound in big-ticket home furniture just yet. That caution could, for now, continue to suppress demand for higher-end furniture items, even as broader retail performance improves. Switching gears to holiday shopping behavior, the season is off to an early aggressive start, but not exactly like in prior years. Recent data from foot traffic analytics firm RetailNext paints a stark picture. In-store traffic over Black Friday and Saturday dropped roughly 5.3% year-over-year across the country. For home goods and furniture-adjacent categories, the slump was even sharper, with home traffic down nearly 10% during that stretch. That trend mirrors what's happening across the board. Consumers seem to be shopping with more deliberate intent, rather than chasing impulse deals. The shift reflects a broader recalibration in spending, as shoppers prioritize essentials or value items over big optional purchases. For furniture retailers, especially those depending on foot traffic during holiday promotions, this could mean a slower-than-expected holiday season. At the same time, the online side of things keeps growing. Data from this year's holiday weekend show online sales rising significantly compared to prior years. That shift away from brick-and-mortar to e-commerce isn't new, but the acceleration is worth noting. For furniture retailers and manufacturers, this underscores the importance of omni-channel readiness. Having a functional, compelling online presence may make the difference between a good quarter and a disappointing one. Meanwhile, beyond retail demand and consumer behavior, there's pressure on supply chains and costs. Recent manufacturing data indicates that furniture makers are feeling squeezed, partly due to tariffs and the broader economic headwinds they bring. Tariff-driven cost increases and related supply chain disruptions are putting pressure on manufacturers' margins, which in turn may constrain the flow of new, mid to high-end furniture items to retailers. For anyone in furniture production or supply, this is another red flag: tighter margins, higher input costs, and potential delays. Connected to that, there's been movement on mergers and acquisitions in the industry. Notably, Hooker Furnishings is in negotiations to sell Pulaski and Samuel Lawrence to Magnuson Home for an estimated $4.8 million. That kind of consolidation may signal shifts in distribution, product focus, or supply chain strategies. For retailers or designers relying on traditional styles, changes in who owns those brands could bring new mix of products, or disruptions, as strategies get reshuffled. Taken together, what does this all mean for furniture industry professionals right now? If you're a retailer or brand owner, the holiday season won't necessarily look the same as years past. Expect more cautious consumers, less foot traffic, and more online competition. That means you'll need to lean on digital channels, possibly revise promotions, and manage inventory carefully. Don't bank on robust furniture sales from walk-in traffic. Online orders and value-focused buyers may drive more of your business this season. If you're a manufacturer or supplier, rising costs, tariffs, supply chain pressure, and a possibly soft demand environment could make Q4 and early 2026 challenging. It might be wise to tighten cost controls, explore alternative sourcing or materials, and prepare for slower reorder cycles. However, moves like the Pulaski and Samuel Lawrence sale to Magnuson might open new doors, Perhaps consolidation will bring new distribution opportunities or demand from committed retailers. And more broadly, the furniture industry is increasingly operating in a retail environment that's demanding flexibility, value, and omnichannel readiness. The mix of cautious consumers, rising costs, and shifting ownership of legacy brands suggests this could be a period of consolidation, optimization, and rebuilding, rather than big, flashy growth. So, for those of you tuning in from design studios, factories, retail floors, or supply chain hubs, this holiday season and early 2026 will be a test of agility. It's a moment to reassess inventory, tighten operations, and double down on online presence, while keeping a watchful eye on evolving consumer behavior and broader economic headwinds. If you found this update useful, I hope you'll subscribe to Furniture Industry News to stay current as things evolve. Thanks for listening.